Hi guys, welcome to another quick guidance video. In today's video, we have with us Purav Shah. He is an alumni of IIM Ahmedabad and he did his undergraduation from the University of Cambridge. We had already invited Purav for the first session of Basics of Investing, and today again Purav will tell us a little bit more about investing and will also let us know what are the different resources that we should look at continuously to know how to invest, where to invest, and what to invest in. So let's just get started. Purav, welcome and over to you.
Hi, so this is the second part of the introduction to investing video. In the first part, we covered things like why you should start investing early, what are the different asset classes that you can invest in, what factors should govern your split between debt and equity, and how you can go about equity investments. In this video, we'll primarily go over debt investments, and we look at different types of debt investments, how to choose between the different types of investments, and then we'll end by with some general principles of investing. So to start off, why should one invest in debt? So there are two primary reasons I think why one should have at least some amount of their investments in debt. The first is stability and returns. So even though equity as an asset class over a long period of time gives you slightly better returns than debt, uh, the equity returns can be quite volatile. So having some amount of debt in your portfolio gives you a little bit of stability in your returns, so that you can be sure that at least some amount of your money is growing regularly over a longer period of time. The second is liquidity and saving for a rainy day. So as a rule of thumb, at least I try to follow that I should have at least 3 to 6 months of living expenses in a debt product or in a product that is going to give me safe, simple returns, over a short and a long period of time. So it's possible that we may lose a job at any point in time. We may not be able to work. There's some emergency in the family that for which we need some amount of money. So it's important to have some exposure to certain debt products at for a shorter period of time as well. The alternative is to leave your money in a bank account, but bank account interest rates tend to be slightly low. So the second objective of investing in debt would be to earn returns that are slightly better than your bank account, but you also get liquidity with that. So those are the two broad objectives of investing in debt: stability of returns and liquidity, so that you have some money in case of certain emergencies. So how do you go about investing in debt? So there are quite a few options if you want to invest in debt. I'll mainly talk about two options. One is debt mutual funds and the other is PPF. There are some other options as well, such as fixed deposits, individual bonds, etc. But debt mutual funds and PPF are the two options that I use and that I like. So I'll be talking a little bit more about them. So starting off with the PPF. So what is attractive about the PPF? So the PPF, for the Public Provident Fund, is a good debt product that gives you stable returns. Currently, it gives a little more than 7% returns. Another attractive feature about this product that it's completely tax free. So whatever returns that you get from investing in PPF are not taxed, which can be a major advantage for some people. It is also completely backed by the central government, so there's an element of safety as well. Um, the biggest disadvantage of the PPF is that it has a 15-year lock-in period. So you cannot take your money out for 15 years, and you will continue earning the PPF returns for that period of time. So investing in the PPF gives you satisfies one of the two reasons for investing in debt, which is stability of returns. Obviously, you don't get liquidity in your PPF because of the 15-year lock-in period, but so whatever debt in debt investments that you have, that you want to put away for the long term. I personally feel that PPF is probably a good option. So the second option to invest in debt is debt mutual funds. So like with equity mutual funds, there are a large number of categories of debt mutual funds, and it can often be quite confusing. I have tried to simplify it here as much as possible. So there are the different categories of debt mutual funds are long duration funds, medium duration, short duration, low duration, ultra short duration, and liquid funds. There are some other funds as well, such as credit risk funds, dynamic funds, gilt funds, etc. But I'll not be covering those in this video. So what is the difference between all these funds, from long duration all the way to ultra short duration and liquid funds? So, so as the name suggests, the long duration funds invest primarily in long-term bonds. Low duration, ultra short duration, liquid funds, they invest in short-term bonds. So what does a debt fund exactly do? So a debt fund invests in bonds which are issued by either companies or by the government. So in return for investing in these bonds, these mutual funds, they get interest payments and then they get their capital repayment as well. So the long duration bonds will invest in the longer term bonds, that will come due in maybe more than 10 years. And the liquid and ultra short duration bonds, they invest in short term bonds, which can come due in the next 3 months, can come due in the next 6 months. So before I talk about which categories of debt funds I like to invest in, I just want to talk a little bit more about what are the risks of investing in debt mutual funds. Because even though you're investing in debt, this is not a completely risk-free investment. So there are two main risks that are involved in investing in debt mutual funds. The first is interest rate risk, and the second is credit risk. So this part may get a little bit technical. So you may, if you're not interested, you can skip forward to the rest of the video. But I think these are fairly important concepts to understand before you invest in any debt mutual fund. So what is interest rate risk? Interest rate risk, put simply, is the risk that the underlying interest rates in the economy move and they move against you. So for example, if you are invested in long-term bonds or long duration funds, if the interest rates in the economy go up, the value of these long-term bonds go down, and hence the value of your long duration debt mutual fund also goes down. So that was interest rate risk. The second risk is credit risk, also known as default risk. So as we've discussed, debt mutual funds, they invest in the bonds of either governments or companies. But there is a risk that the company is not able to make the interest payments on its bonds, or it defaults on its obligations. So this is called credit risk. So basically, if a mutual fund invests in the bonds of a company and the company is not able to make the interest payments or the capital repayments, then this leads to a loss of value for the mutual fund and hence for the mutual fund holder as well. So this is credit risk. So how can we minimize these two risks when investing in debt mutual funds? So you can minimize interest rate risk by investing in liquid funds or ultra short duration funds. So as we've discussed, the longer the duration of your fund, the more interest rate risk that you have. So consequently, the shorter the duration of your fund, the less interest rate risk you have. So liquid funds and ultra short term debt funds, they invest in securities or bonds that mature in the next 3 months and the next 6 months, which means that they have minimal interest rate risk. Second is, how do you minimize credit risk? So you can minimize credit risk by investing in funds that primarily invest in high rated securities. So they invest in securities that are rated either AAA, A1 plus, or sovereign. So this means that the risk of default or the credit risk is very minimal over here. So again, it's important to remember that you can never eliminate the risk completely. Just by investing in liquid funds and ultra short duration funds that invest in high rated securities, you minimize these two risks. So how can an investor find out, how much risk the particular mutual fund is taking? So I like to use this website called valueresearch.com. So valueresearch.com has a great page on every mutual fund that is there. So if you go on Value Research and you search for a particular debt mutual fund, you scroll down and you can see all the securities that are present in that particular mutual fund. And they also give you a categorization of how many of these securities are AAA rated, how many are AA rated, how many are B rated and below, what is the duration of the fund, etc. So Value Research also has a very nice box, that is very informative. So it tells you what is the credit quality of the underlying portfolio of the particular fund and what is the interest rate sensitivity. So if you look at the good quality ultra short term bond funds and the liquid funds, they will have very high credit quality and they will also have very low interest rate sensitivity. So these are the kind of funds that I like to invest in. So going back and looking at the universe of the debt mutual funds that are there, like I've discussed, for my long-term debt investments, I like to use a PPF, and for my shorter-term debt investments, I like to use the ultra-short duration funds or the liquid funds. Of course, there are many investors that like to invest in long duration funds, low duration funds, credit risk funds, etc. My personal opinion on that is that uh, just to get slightly higher return, I do not want to be taking that additional risk. So for taking the risk, I'm already investing in equities. For me, the purpose of investing in a debt mutual fund is that I want liquidity and I want stable returns, returns that I'm okay if the returns that just beat my savings bank account. So this is the approach that I use to manage my debt investments. So I'll just go ahead and quickly summarize, what we've covered across the two videos, and then we'll end with some general principles on investing. So we started off with understanding, what are the different options that are available to investors in terms of asset classes, equity and debt being the two primary asset classes that are there. Then we looked at how an investor can decide on the split between debt and equity. We looked at how to go about equity investments through mutual funds and through individual stocks. Then we also looked at how to go about debt investments, and I discussed how I approach my debt investments through the PPF and debt mutual funds. So I just like to end with some general principles of investing. So I think for any young investor, it is important to start early, even if that means starting small. So the earlier you start, always the better it is, because it gives longer for your investments to grow. It also gives you enough time to learn, to make mistakes, and learn from those mistakes, because every investor will make some mistakes during their investment career. So it's better if you make if you make those mistakes early on in your career, so that you can learn from them and then you can improve going ahead. The second thing is, a principle that I like to follow is save first and then spend later. Whenever our incomes rise, it's always possible to spend that income, but it's important to when you get your salary check or something, it's important to invest money first, and then whatever is remaining, spend that money later. I treat it almost like a tax, on an additional tax that I'm paying. 10 or 15% every month goes into certain investments, because it helps you build that long term corpus. Another principle that I think is that young investors should follow is to continuously invest in your investment education, and keep learning. So there are multiple ways that I try following this. So I like reading newspapers. The Mint is a particularly good newspaper that I like reading. There are certain newsletters as well, such as FinShots and GSN Invest, that give you financial news in a very simplified and easy to read manner, and I particularly enjoy reading these two. There are a number of blogs that are also quite good. Individual investors talking about their investment journey, talking about how they're analyzing stocks and things like that. It's a great idea to follow some of these bloggers. There are some great investors also that continuously write about how they are thinking about investments, what they are seeing in the investment world. So of course, Warren Buffett's annual letters are extremely popular. I also like reading what Howard Marks writes. In India, Saurabh Mukherjee is one author that I quite like reading about. So he writes blogs quite regularly. So through his investment firm called Marcellus, so I like reading those as well. There are a number of books that are extremely good as well. Good for introduction to investing, to learn how to approach investing. Some of the books that I've liked are Intelligent Investor, Coffee Can Investing, Unusual Billionaires. There are a number of other books as well. And the final principle that any investor should follow is that you should always question everything. There are a number of people in the investment world who have a lot of views. Some of them are right, some of them are wrong, but it's important for an investor to always question whatever an advisor or even a friend or a family member is telling them about investments. In fact, you should even question everything that I've said. Does it make sense? Does it not make sense? Is it logical or not? That's the best way to learn and grow, because Only once you have confidence in your own investment abilities will you be able to grow your investments well. So yeah, those are the main points that I had to cover. Just one final point is something that I've not covered in this video is putting money aside in health insurance and life insurance. I think that's quite important as well. It's not been covered in the video, but that's something that any young investor should consider as well. So yeah, that's all that I had to cover. I hope this was helpful for you guys. If you guys have any other questions, you can ask me through my blog. I'll be happy to help, and I'll be happy to answer any other questions you guys may have. Thank you.
That was a really, really great session, Purav. Thank you so much for coming and thank you so much for telling everyone so much about investing. And guys, you can contact Purav on his blog. The link is there in description. Also, in case you have any questions, just feel free to comment and Purav will definitely answer those. Also, just let me know any other topic that I should make a quick guidance video on, and I will ensure that we do that. And for sure, give me your feedback. And thank you so much. See you again soon.